Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. On today's show, SpaceX and Tesla shares both fall. SpaceX now below its IPO price. We talk about why one analyst says Tesla could be headed to an attractive takeover target. Plus, our investment committee today talks consumer brands off the back of many earnings. Tricia Glynn from Advent, Eva Davis from Winston Taylor, and Enna Weng from China Renaissance Global Markets join us. And later, the one-time diamond monopoly De Beers could be going up for sale in a deal worth about $1 billion, a fraction of what it was once worth. We'll dig into the latest with Bloomberg reporting on that. First, let's get to this morning's big deal. Paramount Skydance CEO David Ellison saying that he's highly confident in the planned $110 billion takeover of Warner Brothers despite legal challenges. And they are mounting. Joining us now is Bloomberg's Hannah Miller. Hannah, it's amazing that he's so confident, given the fact it was only at the end of last week that they announced that they were pausing this deal, until June of next year or until some of these court cases are settled.
Yeah, there's a lot of uncertainty here, but there is high likelihood that this is going to be very expensive for Paramount and the Ellison family. So
very expensive. Which direction does it look like they're headed if it is, again, this pause and we're waiting for these court cases?
Well, we know that they're going to have to pay ticking fees to shareholders if the deal does not close by the end of September. So this trial could definitely throw a wrench in that.
I mean, this seems more common to have more states really interfering with this. Was it a surprise when the judge ultimately paused this? Or is it not a surprise that we are seeing these states come in and really trying to challenge these deals? Because we had some challenges from the Europeans, and it seems like we might have gotten past those hurdles.
Yeah, we have to remember in the U.S., the DOJ had already blessed this deal. So it was a bit of a surprise when there's this holdup now with the states. But really, since this deal was announced, there's been concerns in Hollywood that, this will hurt cable and television distribution.
Yeah, it hurts them. And again, is that why we mostly see the cases like concentrated in California, for example?
Yes, Hollywood is talking about this deal, and it's no surprise that California stepped up.
All right, really interesting to keep track of this. I mean, it was like the deal of the year, and now maybe it won't even be a deal. Hannah, thank you so much for joining. That is Hannah Miller from our Bloomberg News team. And as Hannah was mentioning, if this Paramount Warner Brothers deal ends up collapsing, Larry Ellison and his family are going to be on the hook for billions of dollars. Scarlett Fu has the numbers. Hey, Scar.
Hey, that's right, Danny. The Ellisons and their partners could end up responsible for almost $10 billion in costs. And that sum is made up of Paramount paying Warner Brothers a $7 billion termination fee if the deal falls apart due to regulatory issues, and the $2.8 billion that Paramount already forked over to Netflix in February on Warner's behalf to get Netflix to abandon its takeover bid. What's new here is the specifics of who pays what. So Larry Ellison's son, David, runs Paramount, so it would be the father, Larry, and a family trust that would reimburse Paramount for both the $7 billion termination fee and the $2.8 billion Netflix fee. You ask how? Larry Ellison agreed that he would pay Paramount by buying newly issued Paramount shares at some $16 a piece, roughly double where the stock is trading today. Now, separate from that, Paramount will have to pay Warner Brothers the ticking fees of about $650 million a quarter starting in October. So if the deal collapses, the ticking fees go away and Paramount's $7 billion termination fee kicks in. If the deal does eventually close, those ticking fees will be covered by the Ellisons and their equity partners, Redbird Capital and 3 Middle Eastern sovereign wealth funds. Either way, Danny, delays make this deal more expensive, and the Ellisons, they end up shouldering much of the added costs.
Scarlett, thank you very much for that. The numbers keep growing. Speaking of growing numbers, we keep getting deal after deal about data centers. Coke is exploring a sale of Edged. It's a data center developer it co-founded to build projects for the biggest hyperscalers. We also heard news this morning of a $100 billion project between Brookfield and NextEra. Allison McNealy broke that Coke story. She joins us now. Also joining us around the table is Ryan Gould as we talk about some of the major IPOs we're watching. Allison, starting with you, this Coke deal, it's interesting because I feel like we're getting more sales of companies that built up data centers from the ground. I know Carlyle had one recently, too, that you've been covering. So why does it now seem like Coke and others are finally starting to exit some of these investments?
I think that they see an opportunity to kind of, they made this investment to kind of build up these companies. Coke helped build Edge, and they kind of see an opportunity to sort of sell into this hot market. There's a ton of demand, obviously, not only for compute power, but also all the infrastructure around it. So the data centers, the power, the ability to operate and run the asset. KKR launched Helix Digital Infrastructure earlier this year to do the exact same thing. So basically, every private capital provider is trying to get into this space.
And again, it makes sense why when you hear deal after deal being announced. I mentioned that $100 billion one with Brookfield. We also had Meta and BlackRock also announcing one. Is there this feeling, though, as companies try to exit, that multiples are really high and this is kind of as good as it gets? Or are they all sort of saying this is a trend and we're going to continue to ride it and we're going to make further investments, maybe in the case of Coke, even after we exit this one?
I think there is a sense, at least among the sort of private equity folks that I speak with, that there is frothiness in the market. There might be a few deals that end up going a little bit sideways, but the long-term trend is still there. Goldman Sachs research says there's going to need to be more than $5 trillion of spend in the space by 2030, and that private capital is going to be a really big piece of that. So people are kind of betting on the long game and acknowledging that there might be a little turbulence with deals on a case-by-case basis.
All right, Allison, thank you for that. And we are going to have special coverage of that next era and Brookfield $100 billion data center campus deal. U.S. Energy Secretary Chris Wright will be joining Balance of Power at the top of the next hour. And we are, in just about 10 minutes' time, going to be speaking to Mike Dorrell of Stonepeak Capital, one of the largest pure-play infrastructure groups. Ryan, I mentioned that we're here to talk to you about IPOs. Not data center related, not AI related, and maybe like a welcome reprieve. It's Jersey Mike's. So what is the outlook for a company that's decidedly not, forgive the food pun, the hot flavor of the month, that it is something that's much more real world?
It's shaping up, Danny, I think, to be a bit of a hot consumer summer. If you put inside the fact that you have Jersey Mike's, famous, submarine sandwich maker, going public on the same day, pricing its shares on the same day as women's wear retailer Reformation, backed by Permira. I think it's kind of a nice contrast given what we've seen this past month or two with SpaceX and SK Hynix. Clearly, IPOs are a flavor of the month again, to use the food metaphor. But I think it's also a good chance for companies to get out ahead of the August lull. I don't think we'll see too much after these sort of two main ones to cap off this month.
I just think this investment from Blackstone has been really interesting. Maybe one, because they get Danny DeVito as a spokesperson, so good on them. But also, they haven't been holding Jersey Mike's for very long. Exiting this thing after less than 2 years, although I'm assuming they'll still have some control of it when they IPO, seems like a pretty aggressive timeline. Yeah, they invested in 2024. They took the majority stake. I think it's just worth going through some of the numbers. So the offering is $43.5 million shares. About 29.7 million of those are being offered by Blackstone and Ardea, who participated in that 2024 deal. And I think it just goes to the fact that companies are really being encouraged to use those windows when they see them. We hear from bankers and lawyers and private equity firms all the time that you just have to be advantageous, take your, choose your spots, pick your windows, and I think that's what Blackstone's doing here. All right, thank you both so much. That's Bloomberg's Ryan Gould and Allison McNealy on the latest deals. Coming up on the show, hyperscaler capex projected to reach as much as $750 billion, with roughly 3/4 of that going directly into AI infrastructure. Mike Dorrell, the CEO and co-founder of Stonepeak, which specializes in infrastructure, will share what megatrends he's seeing. That's right after this break on Bloomberg Deals. Meta and Microsoft are reporting after the bell today to give investors more insight into spending for hyperscaler. In the meantime, capex on infrastructure and AI-related infrastructure is expected to soar. McKinsey estimates that data center investments will reach $5.2 trillion by 2030. In the middle of that trend sits Stonepeak, with about $90 billion in AUM, making it the largest independent pure-play infrastructure specialist. Mike Dorrell is the CEO and co-founder of Stonepeak and joins me now to take a look at the big picture. Mike, so great to see you. Thank you for joining.
Great to see you.
Look, Stonepeak is so interesting because obviously you have this huge digital infrastructure business, but you also have energy, you have transport too. I wonder, how has the business mix been shifting with this mega trend? What is kind of the divide between what you're doing in sort of the new world of digital infrastructure and the sort of more traditional pure play infrastructure?
It's so fascinating because for years and years, we've had a big emphasis on creating assets, especially in power and especially in digital. And what we found over the last year or so is those huge businesses are now coming together. And what I mean by that is all our skill set in power and going and getting on the grid and developing power, all of a sudden, all the tech players want that. So those two industries and skill sets are really coming together.
So it's helpful that you were already there before this even emerged. But I wonder, with so much capital rushing into this world, whether it be energy or AI data centers, what does the rest of the outlay look like? Can you find things at a bargain because capital is crowding into places that aren't the traditional infrastructure type projects?
In short, yes, but it's not lost on us that the market is at almost historical highs at the moment. You have to go all the way back to the dot-com era to have anything comparable to today. So that's not lost on us. But to go and build these data centers and to get access to the power and all the permitting and et cetera, that is such a unique skill set that for those out there that have that particular skill set and can build these data centers and can build this power, I think it's a really unique moment in time. And of course, you go and get long-term offtake contracts with the Googles and the Microsofts, et cetera. Like, I don't want to make a bet on whether these valuations are going to last long-term, but I'm very happy to make a bet that Google's going to be a survivor and Meta is going to be a survivor. That's a bet I'm very happy to make.
Does the fact that we have these long-term contracts mean that this time is different? That when the alarm bells go off in your head and you say, I haven't seen this since the dot-com bubble, kind of assuage fears? Or do you think still this market is way too frothy and maybe putting the long-term contracts aside, there needs to be some sort of reckoning or correction?
A little bit of both. There's a lot of similarities for sure between dot-com and today. It's a bunch of huge mega firms jockeying for position, and so there's going to be winners out of that. And we're going to look back and say the winners were unbelievable bets today, but there's going to be a bunch of losers as well. But where it differs from the dot-com era from an infrastructure standpoint is data centers with long-term contracts are night and day different from fiber back in the dot-com era, because they're the two big infrastructure bets of the time. So I do make a big distinction between those two categories.
Well, one of the things that, again, has echoes of the financial or the dot-com bubble is the circular financing, all of it. It was a discussion we had to start the year. It seemed like it got quiet, and then it starts up again with us learning to start the week that Nvidia is discussing a $250 billion backstop for OpenAI in one of their data centers. Does that aspect concern you, just how reliant customer and supplier seem to be on each other?
It doesn't concern me, but you have to take it into account. So there's nothing nefarious going on. What's happening here is you've got 5 or 6 of the biggest companies in the history of the world who are all fighting for relative pricing power or bargaining power amongst each other. So Nvidia doesn't want to be beholden to just Google and Microsoft and AWS buying its chips. And so it's trying to fund all these other parties who can be customers of Nvidia. So for sure, if you're an Nvidia investor, you want to be very aware that some of these revenues coming back to Nvidia are circular. But at the same time, I think, again, if you're an Nvidia investor, you want them going and creating a bigger marketplace for themselves. So Nvidia is doing it in a very, very logical fashion, but it does mean you've got the circularity going on.
So if you are to look at the areas that are less safe, that do look a little bit bubbly, that do look a little frothy, what are sort of the characteristics of things you'd look out for?
The thing that really focuses my attention is the need for capital at the moment, and there are certain companies that are cash flow positive, although there's fewer and fewer of those. So
yeah,
Google,
learned that from,
and Microsoft.
I was going to say, Alphabet, though, cash flow negative for the first time last earnings.
You're right, but if Google wanted to get cash flow positive next year, could do it very, very easily. Right. So those folks, I'm not saying there won't be rough roads ahead at some point potentially, but they're going to be fine. The folks you would worry about are those who really don't have internally generated cash flows, and that's obviously the big AI labs today. And that's where, you know, if you're betting on those, you kind of like they've got this big brother in the sense of Nvidia to come and look after them, because Nvidia does not want those guys to fall over. But my big concern would be, as an investor, if the capital markets shut off, because this is what will end it. The capital markets will shut off. Those who need capital but can't get it, like, what are they going to do? They're in some difficulty. Those who've got internally generated capital will just forge further and further ahead.
Are we starting to see the beginning signs of that? Because spreads have started to widen in public debt markets for these big tech players. Do you see finally some pressback, some pushback from this market on the financing side?
Not a lot. Okay. Not a lot. You are right. Spreads have gone out a little bit, and certainly the market is looking at all this CapEx spend, and you don't need to be that bright of a finance person to see that this can't go on the way it's currently going on forever. But I don't at the moment. I mean, CapEx plans this year, I heard you mention earlier, are close to $750 billion. Next year, over $1 trillion. So I don't see a pullback currently. I don't see a pullback in the market currently, but that's what I would be watching pretty closely.
There's always the political element to it, and infrastructure to some degree always is, especially if you're doing public infrastructure. There have been states that have been trying to enforce moratoriums. New York, one of the first successful ones, but just looking at the list, Maine, Vermont, Oklahoma, Maryland, Virginia, Georgia, that don't want data centers, some NIMBYism. What happens if more states are successful? Does it kind of complicate the projects that you're trying to undergo?
It complicates if it kept going the way it's going. So New York's the only state to announce a moratorium today. And it's been, last time we were here, which was maybe 3 or 4 or 5 months ago, we spoke about the likelihood of politics becoming an issue over time. It wasn't even mentioned, when we were talking, and now it's topic du jour, really. So what we're seeing is people don't like power prices going up, but I also think there's a huge, frankly, just social concern of what's AI going to do to my life and my job. And if you go and talk to politicians around the country, all of them are being advised to be anti-data center at the moment. On the other side of that, you go and look at the geopolitics of, the AI competition with China. There's no way the US wants to fall behind. So you've got this two very fast approaching trains just about to collide into each other. So I don't think the New York thing alone is a big deal. There's not a whole lot of big data centers in New York. It's a 1-year moratorium. Right. But if Pennsylvania banned it, or if Virginia banned it, or Ohio banned it, or Texas banned it, then you would see some repercussions.
Right. Mike, I just got to ask you, while we're on the topic of politics, and again, a lot of infrastructure does end to be political. I know Chicago is pushing back the city council on one of the investments you want to make because they're concerned around one of your holdings, Omni Air, which is involved in a lot, but does have a little bit of exposure to ICE deportation flights. Executives have talked about selling that particular portco. Are you selling it? What are sort of those discussions looking like?
Our plan was always to sell Omni. So we bought a company called ATSG. Huge, it's the biggest domestic cargo company in the US. We love it, it's been a great investment, but we always plan to get rid of Omni. I don't want to get involved in politics. I don't want to get involved in controversy. It's nothing to do with that. It was always the plan to sell ourselves.
So that's just proceeding ahead as planned.
You got it.
Got it. So finally, before I let you go, as I mentioned to start this, I mean, you're kind of like one of the last big pure play infrastructure players. Everyone else is getting bought up, whether it be GIP and BlackRock or SoftBank buying Digital Bridge. How often is your phone ringing, Mike, with people saying, "Hey, nice business you got there. Would you like to come join us?"
All the time. But I love what I do. My partners love what they do. We're not selling the firm.
Yeah, so no plans to, even though, would you ever buy anyone then? Or that would expand beyond infrastructure? Or you just want to stay pure play infrastructure?
I mean, we'll see where it goes. We've got a lot of cash on balance sheet, but it's a frothy market today. We need the market to tone down a little bit. But I think if you're cashed up and the market tones down, you go and spend that money somehow or other.
What might you want? Where are gaps that you see that you might want to fill?
Who knows?
All right, well, when you do know and those opportunities do, you know where to find me, Mike.
I know where to call. Yeah.
Thank you so much for joining. So fantastic to speak with you. Insightful as always, Mike Dorrell, CEO and co-founder of Stonepeak. Coming up on the show, SpaceX shares are down substantially since its IPO. Tesla shares also falling after its latest earnings report. We'll talk about why some on Wall Street think that the best solution would be to bring the two together. Plus, Saudi Prince Al-Walid taking a 5% stake in Lucid. We have both those stories next. This is Bloomberg Deals. One stock that has lost its high run since going public, it is SpaceX. It's been beginning to trade lower at one point this week, losing 20% of its value since launch, still easily below its IPO price. For more, we're joined by Bloomberg Tech host Ed Ludlow. Ed, look, there was this concern, considering that more shares continue to get unlocked and the supply-demand dynamic starts to go in a different way against this market. Does it just seem like it would be difficult then to cap this free fall at the moment?
Well, the lockup consideration is just purely mechanical, right? August 6th is a big date. More than 900 million shares hit the market. And then with time, it is a complex lockup situation. More shares hit the market. That's a part of it. But generally, there's a rotation out of high multiple AI stocks. And SpaceX positioned itself as a high multiple AI stock, right? Just based on the business plan outlined in the prospectus. That's been a big part of the story and a kind of disconnect with the commentary so far. They have earnings August 4th, so we'll learn more about how the real business is going. The final thing, Danny, that like relevant to Deals is that they hit the bond market so quick after that IPO that just the action of doing that to a lot of people is sort of bubble territory behavior for the markets. And so like that's a factor too.
Yeah, and the SpaceX debt was really one of the first to trade below par, and shortly after, a lot of the other tech traded down there too. Ed, there's also, since really these two companies have even been a thing, Tesla and SpaceX, there's been rumors of SpaceX buying Tesla. I know RBC out with a note yesterday saying that the price differences, he's going to cut his price target on Tesla to what he sees as an attractive takeover price. I wonder if these dynamics of both of them selling off makes the deal more likely in the mind of many experts.
So the RBC merger note for Tesla SpaceX, they cut to 480, and they saw 480 on Tesla as being a good takeover price, where if that were to happen, the structure would mean that just over half of the shares would be owned by Tesla shareholders. The rumor, the idea of Tesla merging with SpaceX hasn't gone away, and on Tesla's earnings call last week, they were asked about it by a brave sell-side analyst who thought, I'll ask Elon this. And Elon kicked it to general counsel, who said that, this isn't the forum to talk about it, but they did talk about the ways the companies already work together on materials, engineering, and AI, etc. The thesis has very much been that there is benefit of scale in the combined entity. But there are people in the market that think there's an imminency to this, like August. There are people that see it as far-fetched. It is a watch this space.
Yeah, it's so interesting and so bold to ask Elon Musk a tough question, because he's not afraid of yelling at someone for he thinks is not asking savory things. Ed, thank you so much for joining us, Bloomberg Tech anchor Ed Ludlow. Up next, it's our investment committee. We talk consumer deals. Tricia Glynn from Advent, Eva Davis from Winston Taylor, and Enna Weng from China Renaissance Global Markets. Join us just after this break. You're watching Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. This week for our investment committee, we're focused on consumer brands. Earlier this hour, we learned that L'Oreal reported adjusted revenue that beat estimates. The CEO spoke to Bloomberg about those results.
Beauty is a very dynamic category, and it shows once again its resilience in times of trouble. We call it, whether you call it the lipstick effect or the dopamine effect of beauty. The market's growing. It has accelerated a bit in Q2. And people are going for innovation, for quality, and that's probably the reason behind our great first half at plus 6.5%, way above the market growth, is that we brought a lot of innovation and of superior quality into the market.
Let's go straight to Scarlett, who has been following what else companies have been telling us about the state of the consumer this earnings season. Scar?
Danny, we're not even halfway through the earnings season, and retailers have yet to report. But for many of the consumer-facing companies that have announced results, it's clear that inflation is changing spending patterns. For instance, PepsiCo blames the surge in gas prices for consumers spending less on snacks at convenience stores and other places where impulse purchases are made. Just today, Procter & Gamble gave a cautious outlook and talked about winning the value-seeking consumer. General Mills sees an active trade down, with consumers buying its food products more on promotion and less at everyday prices, while grocery chain Albertsons says it's losing many of its price-sensitive shoppers to Walmart, Amazon, and Aldi. Now, at the same time, people appear largely unwilling to sacrifice their vacation plans. Timeshare vacation company Travel + Leisure says nothing has changed from the first quarter in terms of customer bookings, length of stay, and distance traveled. While airlines that cater to premium customers like Delta and United, they see resilient travel demand and therefore the ability to maintain current ticket prices. Another persistent trend is high-income consumers showing few signs of slowing down. They're supported by the still buoyant stock market. To that end, American Express says it's retaining its platinum card holders even after a hike in its annual fee, and more millennials and Gen Zers continue to sign up. Danny?
Scarlett, thank you very much. And that's a perfect setup to this week's investment committee, where we take you into the boardroom debates in real time. Today's IC on consumer deals, and our IC panel today: Eva Davis, Managing Partner in External Affairs at Winston Taylor; Tricia Glynn, Managing Partner from Advent International; and Enna Weng, Head of Capital Markets from China Renaissance Global Markets. Thank you all so much for joining. Eva, let me start with you, because last time we had talked, you'd said, look, my core recommendation, the most attractive target, packaged goods, it's all about protein. Are you still there? Do you still think that protein-focused foods is the most attractive thing in the consumer segment right now?
Danny, I'm still there with protein,
Got it,
but
perfect.
I'll give you a broader theme this time as well. It's really health and wellness. And so health is no longer just a niche aisle in the retail store. It's really the lens through which most consumers are thinking about their purchases. So back to protein. They want protein at breakfast. They want hydration throughout the day. They want gut health at lunch and dinner, and they want to sleep well at night. So if you can lean into the health and wellness and provide that value and function to consumers, that's where the deals are.
Tricia, let me bring it to you, because Advent obviously very active with various consumer deals with you at the helm. What do you think is the most attractive segment right now to be targeting?
Look, by the way, thank you, Danny, for having me. I agree with everything that was just said. I think in food, though, people want flavor. They still want to feel good about that opportunity. And so we are highly focused on those trends around wellness. And having said that, we're focused on foods that people want to eat. Our food portfolio today has brands like Duke's Mayo, Mateo's Salsa. These are high quality ingredient brands, and they also taste really good. Right. Ultimately, this is a little simple in the food space.
Tricia, hold that thought, because I want to come back to the mayo of it all. But Enna, let me bring you into the conversation. And your exposure is really interesting, because you look at both U.S. and more Asian trends, too. Exactly. What are you seeing as like the bright spot in deal making of what are attractive targets right now?
Yes, very interesting. And I echo what Eva just mentioned earlier, is that right now in the U.S., consumers are actually looking for premiums and value. And on the other side of the world, in China, consumers are actually looking into feeling good, and also like emotional connection to the culture and heritage, where we're seeing a lot of consumer brands products right now are local brand instead of Western exporting into China. So we're seeing a trend of going opposite. China brand going global, and which is actually 76% of the total market at the moment.
Does that mean then, Enna, that for maybe a Western company that wants to expand into China, they have to do it through deals? They have to be buying local deals in order to get into the market?
Well, there are the West and East convergence story going both directions right now, right? So we are seeing, for example, actually Starbucks are doing a 60% of divestiture of their China business. And then Nike, most recently, they announced termination of the 2 distributions most recently, right? Just to bring everything in-house. So I think there are many different ways of story of how to structure a transaction.
Eva, how are you seeing sort of cross-border deals and how they're shaping up, and the attractiveness of not necessarily just growing a portfolio within the U.S., but looking to Europe and Asia and otherwise?
So it's interesting. Most of our clients are actually looking more to North America and to Europe. So I can speak to that. And there's really 2 kinds of conversations going on. On the strategic side, it's much more about how do I reconstruct my portfolio, whether it's a geographic, distribution channels, offering different tastes and flavors and wellness in that portfolio. And for the private equity funds, it's much more about following consumer demand and where there's the growth in the demand. So if they can see attractive products, particularly more as an add-on, bolt-on acquisition under their existing portfolio in North America and Europe, they're going for it.
Tricia, how about you? I mean, you are one of those PE funds. Is that the kind of dynamic that you're pushing when it comes to geographical exposure that you're seeing?
We're highly focused on the global consumer landscape, and we do that out of local offices. So 16 offices around the world with deal makers who know that market, understand the local brands there. I think these markets all evolve and change in different ways, but being able to have people on the ground who understand the culture and can interpret it, that is the safest way we've always found to invest in the consumer space.
Tricia, let's get back into the mayo, because Duke's Mayo obviously has a lot of branding power. But how do you sort of distinguish whether that's enough in today's environment when you do have a consumer that feels pricing pressures? Is a brand name enough, or are you concerned at all about consumers starting to trade down as they continue to be hit with inflationary pressures?
Duke's is a great example of this. It's actually not an expensive product. And so you can get a high quality crafted ingredient in a non-discretionary category at a good price. And so, of course, you always have private label, and there's consumers that need that. But generally speaking, consumers are investing more and more in that stay-at-home experience. elevating through condiments, through flavors, through sauces. And a brand like Duke's, I think, fits perfectly into that.
And I wonder what you see, because you did describe a Chinese consumer that really wants that story, that brand. Is that present in the U.S.?
In the U.S., I think you're either going premium, or which is the luxury side of the business, as well as value. So we're seeing a lot of Walmart story, a lot of Costco story. That's where the consumer trends are going. And there's a significant lack of the middle market space. When you're in the middle, you kind of get squeezed out. So I think that it's almost like a barbell shape in the U.S. side.
Eva, what are you seeing in terms of consumer demand?
So in terms of consumer demand, it does go back to value. So they're thinking about functional foods and wellness and what experience does it bring me. They are willing to pay at different segments of the market a little bit more, but you really have to deliver on value. And so that's why it works for some of the legacy brands, and it doesn't always work for some of the legacy brands. And that's why you're seeing some of the strategic activity. Some are placing certain bets around those brands, and others are looking to diversify.
Eva, is beauty still a bit more acyclical than everything else? We're just listening to the L'Oreal CEO moments ago saying to Bloomberg, it's the lipstick effect. People still want little luxuries, even when the overall economy maybe isn't as strong. Is that still the case today?
I think it's still a bit of the case. I do think there's much more activity in skincare around beauty than maybe the rest of the sort of kind of traditional makeup. And you also have to be able to deliver on your promise around the science.
Tricia, let me bring you into this, because obviously Advent has exposure here. Your case study on Olaplex may be a good example of this. What are you seeing in terms of the beauty and more sort of wellness space when it comes to that?
Yeah, Olaplex, and then also the skincare moment. We've just invested in a business called Salt and Stone in the premium body care space. And so I think beauty generally, consumers are absolutely still spending time. It's a category that allows them to invest back in themselves at a reasonable cost when times are tough. And it's ultimately about innovation. I think the hair care category, when we invested in Olaplex almost 6 years ago now, Salt and Stone in the premium body category now, you're seeing these new categories bring innovation, focus, talent, and ultimately products consumers can get really excited about.
All right, only a few minutes here, but I'd love to kind of quickly go through the makeup of these deals and how they might and if I can start with you, where are the most attractive targets? Is it still privately held companies, or is it things like take privates like we saw with Utz, for example, recently being bought?
Yeah, I think great question. I think in the U.S. Western side, we're seeing significant demand and requests in terms of sponsored back carve-outs in the CPG space. Some are majority minority control shift. And another, the third segment that we're seeing is actually a lot of consumer products, consumer brands locally in China are seeking alternative going listing avenue, which is the Hong Kong Stock Exchange. So I think as a consumer investor, if you're leaving H shares or H share or a combination of that route on the table, you're actually leaving multiple on the table.
Interesting. Eva, public, private, where are the deals?
We're seeing much more activity with private equity, and the private equity is really backing those innovative founders that have the insurgent brands. And when we're talking to our founders, it's all about how do I position for the best sale to private equity, with maybe strategics to follow when they're trying to round out their portfolio.
I love that, because Tricia, you're talking about innovation and what you want to seek out. Where are you finding that innovation? Is it taking companies private that are currently public, or is it already privately held companies, rather?
It's all of the above, right? We can take a deal in any particular structure. The key is, what is the product doing? Do the consumers love it today? And by investing, again, in this innovation piece, can we make them love it even more?
Okay, just quickly, about 30 seconds each. Valuations, how are they looking in this space? Enna?
Well, you have to take account of supply chain. You have to take account of a lot of the political risks, and all pricing as the valuation key factor right now. They're not just a footnote.
Eva?
Same story in valuations. Consistent, stable cash flow, not a lot of spikes, as well as seeing a lot of customer longevity and loyalty. Those are getting the highest value.
All right, Tricia, take us home. What are you seeing for valuations?
From Advent's perspective, still a buyer's market. We're excited.
Love that. Thank you so much to today's investment committee. So wonderful speaking with you all. Eva Davis with Winston Taylor, Tricia Glynn with Advent International, and Enna Weng with CR Global Markets. Up next, we're talking about the money behind the game. I sat down with Liverpool FC CEO amid reports the team is considering selling a stake in the club. And later, the group that oversees European football is considering a boycott of FIFA as it looks to raise its own external funds for the first time. This is Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Time now for premium players. The owners of Liverpool are considering selling a stake in the English Premier League club to a consortium of investors led by Amit Bhatia. Bloomberg News reporting that the group hopes to eventually buy a controlling stake in the team. Yesterday, I sat down with Liverpool CEO Billy Hogan, and we discussed the future of the club.
We have been approached by a consortium that's led, managed, and represented by Amit Bhatia for a strategic minority investment in the club, and I wouldn't say anything other than that at this point.
What about, so you mentioned, though, that there are investments to be made. What specific areas would you be looking in with maybe outside capital or otherwise that you think that there might be gaps that could use an influx of cash?
Well, again, I wouldn't refer to anything other than what FSG said. I mean, from our standpoint, as the CEO of the club, my focus, along with our team, is on how we can generate revenue through the mechanisms that we are currently expanding. Mentioned retail partnerships, and how do we make sure that we continue to compete in the biggest league in the world.
How do you think about investment in the talent itself? I know last summer it was a record amount spent, bringing in 3 really star rising players. This summer, you haven't really had any announcements. You also have Mo Salah on his way out, too. Yeah. Do you feel that pressure to kind of make another marquee signing?
I think the pressure, we always feel pressure. That's that's part of being in football.
True.
But I think really from our standpoint, if you look at from a stewardship of Fenway Sports Group over the course of the last 16 years, since John Henry, Tom Warner, and Mike Gordon came in and purchased the club, the focus has always been on how do we improve the club to try and win trophies. Some summers there's been significant spends, other summers there hasn't, and that's correlated to the market, that's correlated to what the team needs, and that's correlated to always doing what we think is in the best interest of Liverpool Football Club, and that's not going to change.
And forgive me for this question because it's part of my tourist knowledge of the world of football, but it's always so interesting to me, the different models where you have maybe a lower down club that kind of bets on unproven talent, and then a big club like a Liverpool will come in and sort of buy that marquee talent when they've already been brought in. Will that ever change? Do you think that in a world where, you did just last summer spend £466 million, that you might change the model and spend maybe more and take a bigger risk on rising talent?
Well, there are financial regulations and financial fair play
which have changed.
Yeah. And we're actually entering a new phase of the squad cost ratio in the Premier League. So it'll be interesting to see over time how that impacts.
Do you think those are positive changes?
Yeah, we've always been in favor of financial regulations. I think that's something that, just from the standpoint of the overall competitive nature of football, I think that's important. And from a football club perspective, and this is frankly across Fenway Sports Group, we've always been focused on running the club sustainably. So my responsibility on the business side, as I mentioned before, is to generate as much revenue as we can to reinvest back into the club. And whether that's on the pitch, into the team itself, or whether that's infrastructure with the expansion that we've made at Anfield, a new training ground, new superstore, et cetera. We've always focused on how do we run the club sustainably. So everything we generate goes back into the team, and those decisions ultimately being made on the football side in terms of how that's invested. But again, all reporting back up to Mike Gordon principally, but John Henry, Tom Warner, our ownership at FSG.
You already lead the Premier League in terms of revenue, and you mentioned some of the growth opportunities, be it around commercial partners or otherwise. But as you look at sort of the long term, the next 5-10 years, what do you think is really the growth pillar for Liverpool FC?
I think one of the areas that we're really focused on is our digital platforms. I mentioned earlier about the e-com and the strength of the United States as a market, but also our ability to expand that. And so that's something that we're working really closely with a number of our partners from a technology standpoint. UPS is a big partner of ours, so working with them as well to really look at how can we continue to grow that aspect. And that's not just about retail, it's about content, it's about our digital engagement. We've got over 225 million followers across our social media platforms, which is 10 times the number that follow the Yankees, to put it into some perspective. So, a massive digital platform that we have. And so looking at how do we utilize that to benefit the supporter ultimately? How do we bring more content to them? How do we engage with them on a more direct basis? And so that's something that when you look at kind of 5 to 10 years out, that's something we're really focused on.
And speaking of the world of soccer or football, if you will, big headlines this week when FIFA announced controversial plans to raise external investment of $4.2 billion for a separate major commercial and tournament vehicle that they're raising, valued at about $20 billion. In response to the proposal, UEFA, the organizer of European football, reacted furiously, saying that it's considering a boycott of FIFA events. Also, a top EU official saying today that FIFA's proposal may spark competition law concerns. Bloomberg's Vanessa Perdomo joins us now to discuss the latest. So what is UEFA saying the reason they don't like this? Is it because they're scared that FIFA's going to go do some Super League thing that will compete with them, or is it just sort of against the spirit of soccer and what's supposed to be a nonprofit body?
It's an interesting idea of why exactly they're, mad about it. The main reason that they're saying is that football is not theirs to sell. They're saying soccer is not an entity, you can't sell it, that the World Cup and the Club World Cup should technically belong to everyone. But on UEFA, the Club World Cup does kind of directly compete with the Champions League, which is what they have.
What I can't get over is that FIFA is soccer's nonprofit governing body. It's based in Switzerland. It's a nonprofit. So how does this mesh? How does it make sense that it's then going to have this new vehicle that would allow for outside investors? It kind of just doesn't really match up,
Well, FIFA has come under the gun for years about the fact that they are a nonprofit. Why does a nonprofit have to garner $15 billion from the World Cup? So this is a way for them to have a for-profit arm. This then becomes for-profit, the World Cup and the Club World Cup and all of these specific tournaments and all of those media rights and all of them, they can technically profit on them under this arm, because they did say even though they'll have outside investment, they will be minority investments, and then FIFA will control this. But FIFA themselves will stay a nonprofit.
Maybe it's good to just get it out there in the open, yeah, we're commercializing the hell out of this thing. I mean, more teams are playing. They had those hydration breaks where they showed ads when they were like, no, it's because we want our players to have
They raked it in during the World Cup, so they're definitely capitalizing on that. The interesting thing, another angle to this, is that Josh Kushner, who's the brother of Jared Kushner, who's married to President Trump's daughter, is one of the potential bidders for this potential stake, which makes it all the more interesting. I mean, he's potentially excited, I guess, but has anyone else supported this?
It doesn't seem like they have. Hey, Vanessa, that's all we have time for. Thank you so much for joining us. That's Bloomberg's Vanessa Perdomo. Coming up, we're going to talk about diamonds and a potential sale of De Beers. This is Bloomberg.
Bloomberg has learned that the De Beers diamond business could be sold by Anglo American in a deal worth about $1 billion. That would be a fraction of what it was once worth. So Leanna Baker is here with us. She's our Bloomberg Deals managing editor. They've been trying to get rid of this thing for a while now.
It dates back to 2024 when BHP made an audacious bid for Anglo. So Anglo, as part of its defense, said, okay, let's try to offload De Beers. In that time frame, we saw the growth of lab-grown diamonds, and that's just really hurt the industry. Although what I'm hearing from fashionistas is that smaller diamonds are actually coming back, because people just assume if you have a big rock that it's fake, or not fake, but a lab-grown diamond. So there has been some backlash to this trend. But unfortunately, the valuation of De Beers has really fallen off a cliff. And if this deal happens, it'll be at $1 billion, but a lot smaller than what it could have been. I think it was acquired for $13 billion more than a decade ago.
Yeah, so that is a big hit. Leanna, thank you so much for joining us. That's Bloomberg Deals managing editor Leanna Baker. That does it for Scarlett and myself for Bloomberg Deals. Stay up to speed even after the show. Subscribe to the Bloomberg Deals newsletter. Up next, it's Balance of Power, live from Washington, D.C.